Welcome back. Time to check out on how the global markets are trading. We're starting off in the United States. A bit of a mixed picture. We had the S&P 500 hitting an intraday high again today. It's since pulled back by 1/8%. Nasdaq, though, at a new all-time high. Dow Jones down by about 1/7%. Still with me at the desk. Oh, no, European markets, forgot those. Closed, of course, FTSE 100 gaining 0.5%, CAC 40 up by 1/4%, and the DAX up by 2/5%. Still with me in studio, Jean-Pierre Verster from Fairtree Capital, Gerbrand Smit from NEFG Fund Management. We're taking your questions, and we have one on, well, it's actually aimed directly at Jean-Pierre, asking what your current offshore exposure is in your funds.
Sure, let me do some maths quickly. I've got roughly 10% of direct offshore shares, roughly 10% in a currency hedge, and then in the South African shares, the majority of the portfolio is also in Rand hedge shares. So in general, I would probably have 60-70% offshore exposure, 10-20% local exposure on a net basis, roughly.
How about you, Gerbrand? Are you also veering towards Rand hedges and offshore exposure?
Look, we took the decision in January 2016 to actually bring back a lot of our offshore exposure. So we cut our offshore exposure about 60% those days. We went SA Inc., we went some resource shares, and it actually worked for us quite nicely until about a month back when we had Gigaba's appointment and cabinet's reshuffle and so forth. So, but over the last month, we probably moved back. Look, the ALSI 40, if you take the market in whole, is about 70-30. Rand hedges towards SA Inc. Income streams. We probably went to about 60-40, where we had 60% not Rand hedges and 40% still Rand hedges and offshores. We're probably back to about 50-50 on that specific call, and we're increasing when we get good days on the currency a little bit. So our views have changed a little bit from what we had January, and we're busy asset allocating. At the moment, about 50-50.
Yeah, and of course, hindsight is a great thing. And view on Baldwin Properties. Do either of you look at Baldwin? I think they're coming up with results next Monday.
Yes, I like the company a lot. I think it is.
It's residential, isn't it?
Mostly residential property development, and more lately also then holding some of those in stock to rent out. And I'm glad they've got that flexibility, because my concern is the macro environment. Because of this second reshuffle or second change of the finance minister, unfortunately, it has a dent to confidence, and it means that we'll probably not see an interest rate cut anytime soon. So for the first-time home buyer, someone who's buying the type of unit that Baldwin sells, that market is probably going to be under pressure in the coming year or even longer. So if it wasn't for the macro environment, I'd probably buy a lot of Baldwin. Given the macro environment, I own some Baldwin, but I probably won't buy more, even though I think at this price it is an opportunity, because they still make their profits mostly on selling units, the development of the properties.
And the share price hasn't performed that great since they listed, has it?
Correct. But the point is, it's not annuity income. You need to keep on developing, and for that you need to keep on selling units, and for that you need to keep on having young people moving out of their house, getting home loans and buying these units. And I think in the short term there's some challenges to that whole business model. But in the long term, they've been through cycles before. I do think it offers value at this price, and that's why I'm a holder of the share.
And you're saying to people, leave home now, get your own place. Do you like Baldwin?
I don't know. I'm not an expert on all the property companies that listed recently, so I haven't even looked at the small property.
There was a spate of them.
We're a bit scared on local props, just on cost of capital. We're scared of what's happening with bond yields. We don't think we've already seen anything where it should be priced. We think bond yields will probably go up in the next year or two, unfortunately. So, yeah, the whole cabinet reshuffle has certainly changed our view.
Well, I'm going to give you another question then, Gerbrand. It comes from Katlejo, and she would like your view on the Satrix Property ETF and why you would or wouldn't buy it for the long term.
Yeah, look, if we were 2 months back and we had green shoots in South Africa with interest rates coming down, was our view in the end of this year. We had food inflation coming down massively. You couldn't almost see that there won't be interest rate cuts over the next 18 months. Certainly, I would love property. They correlated highly to 10-year bond yields everywhere we go in the world. That view has just, I think, changed over the last month or two. So I'll probably still stay away. They aren't that cheap like they used to be. It is volatile sector. We know that these things are actually twice as volatile as shares when you have a movement of more than 100 basis points on bonds. And that's our concern. We still think we can have a bond, bit of a blowout in a year or two's time if the government doesn't stick to the fiscal policies like they used to have. And a lot of the local good fixed interest fund managers already own no government exposure, and that's a bit of a concern. So a lot of foreign buying at the moment. I'd like to see who buys that when they leave. And that's the inflection point where you probably wait for before you'll buy property or bonds again in South Africa.
Okay, well, here's a question I'm sure I can guess the answer. Is this a good time to switch to active managers, Jean-Pierre?
Sure. Well,
Yes.
I'll be talking my book if I say yes, but let me give some nuance to the question. It was the Berkshire Hathaway AGM over the weekend. And once again, Buffett said that for 99% of people, and a well-diversified index fund is the way to go, and that in aggregate, active managers don't add value. And he's 100% correct. I agree with both those. So what I'm saying is, don't give all the active managers a little bit of your money and have a lot of different active management companies managing your money. Otherwise, you'll get the average of them. And that average will tend towards the average of the market, minus the higher than average fees. So if you want to go to an active manager, you need to pick one that you think will outperform. Now, that's very difficult before the fact. But there are some active managers in the South African market. You can look at a number of funds that have done better than their benchmarks, including the All-Share Index, after fees over the long term. And the question is, will they continue to do that? Will someone who in the past has underperformed will keep on outperform or will start outperforming? You need to answer that question. I can't tell you the answer to that question. It's like forecasting what a share will do. But just like we can try and forecast what a share will do based on the management team of the company and the business model and the philosophy of the company. So you can talk and listen to fund managers and decide, will they outperform in future? And then, yes, an active manager that's above average is better than a passive solution.
Okay. Well, I mean, Gerbrand, you mentioned that you quite liked some of the offshore ETFs, or you would look at an offshore ETF because they're not driven by single shares. And we have a viewer that asks, should the JSE change the composition of the ALSI with Naspers making up 20% of the index because it puts investors under the false impression of a real market and it makes it difficult to trade properly?
It's a difficult one to answer.
Yeah, because Naspers does.
It would be
that
easier
illustrates
to actually
your point.
track it from a unit trust point of view, because lots of our funds we actually track either the SWIX or the ALSI 40 if you're manager of an equity fund. So certainly it would be nicer for us because we got certain ASISA rules that we actually only to go 10% in a specific stock, and then it can grow to bigger, but you're not allowed to buy more in those shares. So from a unit trust perspective and a manager from that perspective, yeah, it would be nice. It would be easier, make my life easier to actually start beating the index if you got a Naspers that just keeps on growing 20% per year on a share price valuation. But that's how markets are made up. It's been made up that way for many years, and that's the rules, and that's the game, and I don't think you need to change that.
Yeah.
It would be nicer for us.
Okay.
The SWIX has actually, I think, 25% weighting now. Sure. I've actually looked at it today. It's crazy.
Okay. So panel's view on Sibanye Gold.
I'm not a fan of gold companies. It is a completely different animal now that they bought.
Sibanye Gold and Platinum.
Yes, exactly. It might become Sibanye Platinum soon. Yeah. Look, I think they're very shrewd in terms of with the, on average, lower length of mine, life of mine of the South African mines, gold mines, to firstly have locally gone through the Aquarius acquisition into Platinum, and then secondly, having made the Stillwater acquisition. I think that was shrewd. They probably would have hoped for a higher share price to do the rights issue. That would have protected a bit more value. But now the prospects of the company is more aligned to what will happen to platinum and also palladium versus gold. So if you can tell me what platinum palladium will do, I can tell you how well Sibanye will do. But because it's based on two commodities and I can't forecast the commodity prices, it's typically not a company that I like to invest in for the long term.
Okay, and for you, Gerbrand?
Yeah, we like it. We're a bit scared of what the rights issue price is going to be because that can destroy value if you're already a big shareholder in it. So we're not a big shareholder in it yet. We think platinum is okay. It is difficult to actually look at commodity prices and guessing the next 2 years' price. Yeah. But yeah, we think where we are in the platinum cycle is just amazing that the platinum price hasn't actually done anything. If you look at all the trading statements coming out and the production statements coming out of all the platinum players over the last month or two, these guys are non-making profit where they are actually all-in sustaining cost producing it at the moment. So somewhere it needs to actually fail, go down, and you need platinum prices to go up again.
Yeah.
We had that similar thing, I think, 2 years back or 18 months back, where Lonmin was supposed to be left alone and probably should have closed their doors, and you had an equilibrium already and higher platinum prices. The PIC and some other shareholders didn't think so. And they pumped in new money into that, a few billion rand into Lonmin, and as far as I know, they probably burned that cash, and we might see a similar situation in the next year or so. So if you look at a 3-year, 5-year view, I'm positive on Sibanye.
Okay.
I think some platinum players are going to disappear. The less better production guys and fixed cost, getting those down. And Sibanye is probably the better guys on doing that. So we would not shy away from a bit of risk in a cyclical game.
Okay, I haven't left you very much time at all, so you've got like 20 seconds each for your stock picks. Jean-Pierre, Alphabet's the owner of Google.
Yeah, so one of the things that Buffett also said over the weekend was, damn, he missed Alphabet. I'm saying, well, maybe one still hasn't missed it. Sure, it's not as cheap as what it was 5 years ago, and the share price is definitely higher than what it was, but from going from a core, call it focused on the browser and search on the browser, having through Android control of the small screen of your cell phone, through Google Music, Google Play, and even other things like their self-driving cars and other initiatives they're doing, the culture of the company is such that I think there will be new arrows to their revenue quiver, and therefore I think we can still at this price buy Alphabet.
Okay, and Gerbrand, you're going again with the Zambezi Preps, and you've chosen them before. You like those.
Yeah, I'll go short. We don't think Northern will close its doors. That's the risk involved in this LB pref share transaction.
So you're going short Zambezi Preps?
No, long.
Oh, long. Yeah.
You buy it, I think, at a bit of a premium at the moment, 2 or 3 or 4%. But still, if you hold it for 8 years, you're going to earn prime plus 3.5, which is 14% at the moment, compounded over the next 8 years. And where markets now, I think you're certainly going to struggle with the 14% compounding growth over the next 5 years. So certainly something to look at.
Okay, gents, we have to leave it there. We didn't get to all your questions. I will tackle them tomorrow, or Julietta will if she's doing the show. News is up next.